Hi, my name is Heather Nelson with Build Idaho, and I'm sitting down with two of my preferred lenders. If you guys want to introduce yourselves.
Yeah, Dylan Watts, Bryce Gonzer. We run the Village Fulcrum branch here in Meridian.
So our Q&A is kind of going to discuss a few different topics, one being where our local housing market is currently at, moving into a few different topics with our lenders and questions that we've had come up regarding the housing market and lending side so that we can get your guys' questions answered, as well as if you guys are seeing this live, add your question as we're going through this information and enter in to win a $50 Amazon gift card. So we're going to get started now with a little bit of our Altos report. So this is coming from today in the Boise area. I just want to touch on the fact that our price point is up, actually increased month over month from it is now up 549.9, and inventory is actually decreased down to 383 homes on market. Again, if you would like these Altos reports printed out, I'm happy to do that. Just drop your email address below and I will send these. We can do weekly updates so that this is the leading indicator in the housing market here locally. And moving into that, I wanted to touch on um, new construction and what that looks like. So month over month between November and December with new construction in Ada County, we are actually down. Okay, what that looks like in November, prices fell. They were actually at 623,000 for the average home purchase price, and homes sold in November was 168. Month over month, that's actually down from November to December. Inventory came down from 876 homes on market with new construction to 800, bringing down that purchase price in December to 549,000, the average. And actually, our homes sold went up, increased by 236 homes. So inventory down, homes went up for sold, and pricing came down for November month over month. So I kind of like to track those to keep a good pulse on where new construction is headed. Now, tying into that, I wanted to touch on permits because as I have been working a lot with clients in new construction, they've seen month over month from November, maybe in December, a lot of builders giving incentives to get some inventory off their books for the end of the year. And now moving into the new year, we saw from 2021 to 2022 with home building permits drop. In 2021, we actually had 8,146 new permits pulled, and for the year of December, that actually dropped to 2,023 permits year over year. So we're now seeing permits kind of drop, which is going to tie into inventory moving into the summer to end of the year inventory on market. So that's going to actually make that inventory supply and demand a lot stricter and giving you as a home buyer, if you are looking at new construction, a little bit less kind of choices to choose from, and that might pull our price points. They could potentially go up with the supply and demand kind of issues. So with that, I kind of just wanted to touch on those kind of topics when it comes to new construction, so you can see where new construction is heading for the rest of 2023. And now we're going to kind of talk about feds and what we've seen with the feds meeting and rates with Dylan and Bryce.
Yeah, so just to kind of recap on that too, because we've been talking about this a lot. There are still a lot of people moving here from out of state, and the fact that builder permits are down in Ada and Canyon County, I think it was something like 45 to 50% year over year. We don't have this big inventory surplus that a lot of people have been concerned about, and that's really what causes pricing to come down. So despite us being, I think we were at a 23-year low at the end of 2022 for mortgage applications. And despite that, our prices still really didn't come down all that much year over year. Um, the big change that we've seen the last couple of weeks, and this is getting a little bit ahead of us to another slide, but we saw a massive increase in mortgage applications over the last few weeks. And we've kind of been calling this and talking about this from a very early standpoint is when rates do start to come down, which they have over the last couple months, there is going to be a big jump back in the market of buyers who have just been on the sidelines waiting for that to happen. When you couple that with, again, still people moving from out of state back to Idaho or into Idaho, and then a reduction in new inventory, we're going to be back in that same scenario. A lot of us believe that we are going to be in that scenario where inventory is super tight again, and all of a sudden you see these surging house prices again. So if we are still on the sidelines waiting for 6 to 12 months out for rates to get another percent lower, so you might be paying another 10 or 15% for the same house when you could have bought now and refinanced a little bit later.
Yeah, I
Yeah.
like that. And with having probably more inventory to choose from, versus waiting and there's even less inventory, and now you're back into a high demand, less supply kind of situation.
Yeah. So, and I believe, are we up on that slide right now? Can't we?
Totally.
Pardon me. So, um, something we've talked about a lot is even though they're not indirectly correlated. The Fed funds rate does not directly impact mortgage rates. So even though we're projecting another one or two rate hikes in the next couple of months from the Fed funds, we won't actually, or we don't expect to see mortgage rates to continue to come up. A lot of that has to do with the inflation reports that have been coming out. On the slide, if you guys are looking at it right now, we've seen inflation finally start to come back down, and the Fed really wants to get back to their goal of a 2% year over year target rate. Now, the report that came in, it came in early January. The report was for December, but that's still showing at 6.5%. But the important thing to look at is the actual month to month increase has been very, very minimal over the last couple months. We actually saw a decline technically for December's report. So if we do extrapolate that out at our current pace, we're well, I mean, I think we're actually well under if we were to extrapolate that out a 2% target rate for the next year if it continues like that. So the Fed's seeing that, and I think for the first time is starting to talk about maybe pivoting the rate hikes. But again, even though they still probably will go through with their next 1 or 2 months of rate hikes, it won't directly impact mortgage rates. And we see those continue to come down over the next few months. Again, even though the Fed is increasing rates, those are short-term borrowing rates, not necessarily mortgage-backed securities.
Yep. So there's a big correlation between inflation coming down and, like Dylan said, the 30-year, going conventional interest rate. What's going to be interesting to look at, guys, we're approaching a very pivotal time where inflation is dropping, and mortgage rates are also dropping. What we need to look at is the Fed fund rate. So as soon as the Fed fund rate crosses the overall year-over-year inflation number, typically, if we look back historically through past times of recessions, 2008, 2010, going all the way back into the early 80s, we can see that typically once those numbers cross, the Fed will go to start pivoting. So they'll begin to decrease the Fed fund rate versus raising it. And right now we're pretty close, about 50 basis points or so from those two inverting. So that's another telling sign that we're close to the end of this thing, and a lot of liquidity will start to come back into the market once they announce that actual pivot with the Fed.
Awesome. One quick question for you that I've kind of been hearing or seeing when the feds met, they were saying, yes, we're going to pivot, but do you think they're going to hold rates for, they said it could be some time that they're going to hold rates before they start coming back down with rates?
Yeah, that whenever Jerome Powell speaks, he tries not to shake up the market too much, and so they've been consistent with stating they're going to continue hiking until they get inflation under control. However, what he's done is he's hinted at potentially 1 to 2 more actual hikes, and then reassessing from there, or they might be able to actually bring the Fed rate back down. And
Okay.
so he's not going to clearly state yes or
Yes or
no, but
no?
he's definitely, that's what it's kind of alluding to, and that's what we can see with the traditional legacy system as well. That's what they're thinking. And over the last several days, there's been a massive rally. Yesterday and today have come back down, but that's what it's alluding to, is that maybe 1, 2 rate hikes, very minimal, 25 basis points potentially, and then as we approach November, end of 2023, Fed fund rate begins to start dropping, and that's when you're going to see a lot of liquidity come back into the market. Asset prices, stocks, real estate really starting to go back up.
Okay, awesome. And then too, that it plays in a factor with unemployment too. We haven't seen, they were hoping unemployment was going to come down, or there'll
Right.
be more unemployment, and we're still seeing, a strong market for.
Yeah, strong labor market. It's a lagging indicator. So there's multiple companies, Wells Fargo, Goldman Sachs, a lot of tech companies that are laying off thousands, tens of thousands of people. We're not going to see that for a couple months. And unfortunately, that's part of what happens in an inflationary environment is jobs will eventually drop. We'll kind of cross that bridge when we get there. And I think over the next several months, you're going to start to see unemployment rise a little bit. But hopefully the Fed is able to kind of contain that with the Fed rate eventually coming back down, inflation coming back down. Those are all strong positives, although I think you will start to see jobs increase.
Gotcha. Okay. So next slide we're going to go over is the future predictions.
Yeah, and we kind of talked about this briefly. I got a little bit ahead, but like we mentioned, as rates continue to fall, buyer interest we've already seen it start to increase again. We felt it locally just within our company. Our mortgage applications have gone up a ton, and our branch volume went up 30-40% in a matter of 2 or 3 weeks.
Yeah.
And I think I know there's a stat. Oh yeah, it's on the page. So there was only a 4% decline year over year compared to the same week last year. Meaning, we were in one of the busiest markets we've ever seen last year, at least at the start. Obviously, that tapered off after a couple of months when the Feds did start to raise their short-term borrowing rates. But to start the year, we were still in a really, really big market. There's a lot of lenders that had, record months in January, February. And again, the fact that we're only 4% down is a pretty big indicator that buyers did get back in the market. So no one has a crystal ball, but again, just with our local market at least, we do see inventory being an issue potentially, especially if this trend continues that we've been seeing at the start of 2023.
Yeah, and it's a good, that's why we kind of want to sit down and answer your questions and kind of give you some local insight within real estate, what realtors are seeing with showings and offers, and with the lenders on the mortgage application side, we are seeing more buyers come back out to the market, and I think feel maybe a little bit more confident when they're coming back for 2023 to look at homes, and really seeing that the market hasn't, yes, it's softened and corrected a little bit here locally, but we're not seeing, things decline as rapidly fast as you've seen on clickbait articles across, social media platforms. So we will continue to kind of give you data information and keep trending and keeping track of what's trending, I think, with data information moving forward in 2023.
Right. Yeah, guys. And it's kind of, we move to the next slide. I'm gonna kind of piggyback off what Heather said. It's important that you're talking to somebody that is, a expert in this field, talking to an agent, talking to a lender, because like she said, there's a lot of clickbait out there. And I'm sure we're seeing, some of it where there's a lot of institutions that are shutting down right now and they are laying off people. And ultimately what that comes down to is that the traditional way of doing mortgages, whether that's a retail institution or a bank, they're very, very expensive. And that's why rates are different from, who you talk to. It really comes down to their back end. So a lot of headlines like, Wells Fargo is, shutting down their mortgage division pretty much. They're only specializing in minority communities and with people that bank with them, high net worth individuals. We've seen Finance of America shut down their mortgage division. We're seeing Loan Depot lay off, thousands of people. And so although these headlines are scary, what they're not showing is, mortgage broker dominance increasing. So there's always two sides to every story. Mortgage brokers now own the majority of the market share from the first time since 2009. And the reason that has happened is because they're so competitively priced. These other institutions, Wells Fargo, Finance America, although maybe great companies, they're very expensive. And mortgage brokers like the one that Dylan and I run, which is Fulcrum Home Loans, we're not that expensive. We don't have the expensive CEO salaries, the VPs, the shareholders. And so there's no need for us to charge what the going market rate is on the back end, which again ultimately puts you in a better position to have a lower interest rate than the national average. So although the headlines might be scary, it's because of how expensive they are, and then due to the liquidity crisis and everything pulling back, they're not able to profit, and that's why they're starting to shut down and lay off these different institutions and employees.
Awesome. Yeah. Thanks for that insight too. That's super helpful.
For sure.
All right, moving to the next slide. This is just kind of doing another example of, in this current market, we do have a lot of negotiation power as a buyer. So there should be two examples of basically 2 monthly payments with a seller concession, which on almost, I'd say 19 out of 20 deals we're doing right now, we're able to get seller concessions built in, which were the previous 2-3 years. It was not only were you not getting a seller concession, but you're also offering 30, 40, 50,000 over asking prices, which is what led to that surge in price. But in this market, again, seller concessions are super common. And the nice thing is, even though, let's say today's going rate, just for a rough ballpark, let's say it was a 5.875 at no points, no buy down there. The new and updated rate with a buy down could be as low as a 4.99 or 5.125. So if we're waiting for
Wow.
rates to get back into the high fours or even low fives before buying, we're there right now in the current market because we're able to get seller concessions. Now, bringing this back just a couple minutes ago, if inventory tightens up and it flips back to a seller's market, those seller concessions are going to be off the table very quickly because they're going to have multiple offers on the same home price, and they're not going to willingly give up $10,000 or $15,000 out of their net proceeds when you have another full price offer not asking for concessions. So it's just another thing to be aware of. Again, just if we're waiting on the perfect opportunity, I don't think you're ever really going to time it, but I do think the next few months where, again, prices are relatively low right now, and we do have a lot of negotiation power, and that could flip just as fast as we got into this position. So just something to be aware of.
Yeah. So what does that kind of do, like, as you're looking at that slide? So you get that $15,000 concessions from a seller that is motivated in today's market. What does that kind of like break down as far as like what could you essentially save? Because when I was doing the math yesterday, I think between the two, if we have, a motivated seller versus a few months down the road, with less inventory, more buyers again, that payment difference is like roughly $125 difference between getting, a $15,000 concession from a seller versus not, and actually you come in with $6,500 less in today's market, essentially, then you're going to have to come in with more money, probably not get a great rate compared to what you can do with that interest rate buy down, those seller concessions right now, right?
Yeah, exactly. So just to kind of run off this comparison in the slide, on a $500,000 purchase price, if you're planning on going 20% down right now, that's $100,000 invested in that property. Now, if we don't have seller credits on the table, you're also going to pay, let's say, $6,000, $7,000 in closing costs. If you're also wanting to buy your own rate down, a single point is based off your loan amount. So on a $500,000 purchase with $100,000 down, your loan amount's $400,000. A 1 point buy down, not meaning 1%, a 1 point buy down, which gives you about a 0.5% lower in rate, is going to be $4,000 in addition to those closing costs. So when you do not have a seller credit, you're looking at maybe $6,000, $7,000 in closing costs without the buy down, and then you have to add another $4,000 on top of that to buy your rate down to maybe a 0.5 point. So you're not only out the 100,000, you're now looking at another $10,000 or so to get yourself from, again, let's say it's a 5.75 down to a 5.25. But in this market, that seller credit can be used to fully cover closing costs, that 7,000 or so, and then we can buy the rates down even further. So if we do, just for a perfect split, let's say closing costs are $7,000 and we have $8,000 remaining of that seller credit, we can take that full 8,000 and get your rate even lower with no additional funds out of pocket for you. It's a great setup, and again, it's one of those things where you can get, I mean, high fours for a rate is phenomenal, especially when you're not paying any closing costs out of pocket from a technical standpoint.
Yeah. That's why it's a really great time, if you have a, 2 years work history, you have a great job where you don't plan on, that I think factor changing in the next few years. Why today's market is so great for buyers compared to, the market we just got out of where so many buyers actually, tapped out and couldn't afford to be in the market. So today you actually have that opportunity, to get back in and really save some money when coming, cash to close kind of situation.
For sure. Yeah. Sounds like we have some Q&As
Yeah,
too.
yeah. So you guys and clients that we've kind of discussed, some topics and questions that they had, moving into why we wanted to sit down and do a Q&A together. I've got a list. If you guys want to, add some questions as we're going through, be happy to. Question number one is, if I apply for a mortgage, how much does that impact my credit?
Perfect. Yeah, I'll take this one. So we do get that question a lot. Even a hard pull is going to drop off your report in 30 to 60 days. So it's not something that you should be super concerned about, especially if, I mean, there's a couple different scenarios. If you have phenomenal credit, you're 780, 800 credit score, and you're worried about a hard credit pull dinging you 5 points for 60 days, it's almost a non-factor. Like your report is going to recover so quickly. And the nice thing too, if you are in that category, For mortgage applications, 740 and above is the same pricing. There's really no difference between a 740 and an 800. So if you're saving at 800 and concerned about a 5 point ding, it's not something that, I mean, I wouldn't be considering it. An 800 is just like,
Yeah, it's not going to negatively impact your borrowing capability. So anything above 740, you guys are good. Then we have abilities to, see if you're at 720 or 730, what do we need to do to get you into that premier pricing? But it's always better to start sooner rather than later, develop a plan, and then you guys have, good expectations moving forward.
yeah. And just to feed off that, I mean, if you've never had a hard credit pull and you don't really know what your credit score is and you think you might be around, say, 650, 660, and you're just relying on some online reader where it's a single credit bureau that's not even actually doing a full credit report, there's a lot of misreporting or account lines that can be missed. So if you're holding off until, a month or two out from when you actually want to be in a home, and we find out there's 3 or 4 things we could have done over the past few months to improve that credit score, that's a much better scenario than holding off. Because I mean, just getting advice on what account lines to, maybe we pay down a credit card to a certain percentage, or maybe we go try to tackle a collection from a medical report, something like that. Those can have 60, 70, 80 point increases, where again, the negative is a 5 point decrease. When we have a potential to increase it by 7 or 80 points, I'd definitely take the positive route there.
Yeah. And it's really great if you, are possibly considering buying a home in 2023, even next year. I think it's helpful to start the process, look at your credit. If there's anything that you need to work off between that time frame, we have a window to do so and kind of get you on a plan to become a homeowner and start building, wealth through real estate. Okay, so question number 2, how much do I need to put down as a first time home buyer?
Yeah, so that ranges, guys. There's many opportunities out there. When you hear first time home buyer like eligibility, that's Fannie Mae's 3% down option. So there's no benefit to like pricing or anything like that. It's just your ability to borrow 97% in the form of a mortgage, and you guys come to your closing table with 3% down. Now that being said, Idaho has a great bond program, probably one of the best in the nation. It's called Idaho Housing Finance. They allow you to put 0.5% down. They still follow Fannie Mae's rules, which means if you're putting 0.5% down, you're going to borrow 2.5% from Idaho Housing. That's going to come in the form of a second mortgage. Now, if you can come at least with 3% down right now, and we can get closing costs covered by the seller or a gift, that's ideal, because with Idaho Housing, you're going to have a second mortgage on there with a separate interest rate for a period of time, and so
Yeah.
it's ideal if you can go the 3% down. But if you can't, it's obviously better than renting at the end of the day. So those are the couple options that we have. And then after you do one of those programs, the next kind of tier for that is if you're buying a second, new primary, going a conventional route, it's 5% after you used up that first time home buyer eligibility.
Oh, awesome. Okay. That's hopefully good information for you out there to know. All right. So third question is, are high interest rates something that should prevent me from buying a home?
So I'll kind of backtrack this. I think I said this earlier. There's never going to be a perfect time. You're never going to time, the bottom prices and the lowest rates. That doesn't really correlate. If you can afford it now and you're comfortable with the monthly payment and it's not something that's going to, negatively impact or stress you out on a daily basis, I mean, the sooner you get in the market historically, the better your return on investment is going to be. And whether you're looking at this as an investment opportunity or just, we want a place to live where the rent's not going to increase. Either way, the sooner you get in, the better you're going to be off. Again, granted that your employment is stable, you don't have concerns about future employment, and you're comfortable with the monthly payment. If you can do it now, I mean, trying to wait to time the market just hasn't turned out. I mean, you look at it, investors, even people that spend their entire life trying to study the market and time things don't do it. So
Yeah.
it's
The average investor is usually your worst enemy. They've done statistics on people that try to time the market versus putting in the S&P, just buying real estate, and they perform dramatically worse than just getting into it. And the other thing that you have to think about when getting in is, although it is a higher interest rate environment than it was a couple years ago, historically they're about average right now. And the other thing you have to look at is inflation. Inflation isn't just, a lot of people think inflation is the rise of goods and services. It's not. It's the actual debasement of a currency. So the money that you're earning every single day when you go to work, that you're saving up, is earning you less year over year. And so, if we look at W-2 workers right now, they're on average, they're earning 3% less every year, where you keep your money at a bank is not yielding you even 1%. And right now inflation is at 6%. So how do you save up for a down payment when, the money that you're earning is not keeping up with inflation, while asset prices are continuing to slowly rise? And so if you're in a position to put your money into an asset like real estate versus paying 100% interest in the form of rent, that's the ideal situation, and you can always refinance later.
Yeah, it's like most of us say, marry the house, date the rate. That's, it's definitely true. And as a realtor, I always ask my clients, is this a 2 to 3 year plan, or is it more of a 7 to 10 year plan? Because most nationally, most or the average homeowner stays in their home at least 10 years now. So within 10 years, our economic cycle, right, will drop and come back up, and you'll gain equity later down the road.
Right.
Historically, to
For sure.
Okay, so moving into question number 4, is there, oh wait, nope, just kidding. Question number 5. If prices continue to lower, if prices continue to lower and I buy now, can I refinance later if prices come down?
Yeah, so essentially what this would be looking at is, do you have enough equity if you bought a $500,000 house and you put, let's say it's $50,000 down, and in a year, we don't see this happening, but if we had a drastic decrease in home prices, let's say the home prices came all the way down, that $500,000 house is now worth 450,000, and your loan amount's right around 450,000, so you're at 100% LTV. In that scenario, you would not be able to refinance. The likelihood of that happening is extremely rare. That's a massive decline in prices, where again, inventories and demand is what's driving those prices. Now, we've also talked about this, and this is kind of a bigger picture economic question. Um, the Fed and the government obviously do not want us to enter a really, really bad recession. Their whole thing is to get inflation tamed, and they are willing to, increase unemployment, things like that, but they really don't want a repeat of 2008, 2009. I mean, that took a long time to recover from. And to be fair, we always talk about this. We're not in that environment. We don't have the inventory surplus we did. But even that being said, typically when that happens, like if we do head into a position where people are foreclosing on homes and inventory does start coming up, that's when the government and the Fed start to step in again and come out with new stimulus programs, new programs dropping interest rates. Even, I could see them allowing even higher LTV refinances in order to prevent people from losing their homes and going into that scenario. So it's not like the government and Feds are trying to drive us into this terrible recession. Like, they're well aware that's not their goal, and I don't see that happening. But
Right.
yeah,
This is a completely different market compared to 2008. The 2008 global financial crisis was spurred on by predatory lending and really came from the real estate industry. And this one, real estate is just suffering because of the inflation of the U.S. dollar. So, like Dylan said, back in 2008, at the height of the crash, there was 3.6 million homes plus on the market, that were excess inventory. We're not even close to that right now. So that's a huge difference. Predatory lending went down over 1,500% year over year. But even if we went back to 2008, we started to see price home recovery 24 to 36 months after that. And so, if you're going to compare apples to apples, kind of like what Heather said, if it's a 5-year plan and home prices continue to fluctuate a little bit, you're not going to see another 10% decline in this market. I truly, truly don't believe that. But if you're going to hold that house for 5 to 10 years, it's really irrelevant. At least you're gaining and paying yourself back in the form of principal with a mortgage payment, and you're getting some equity in there versus 100%. And Idaho's a very unique state as far as foreclosures go. We're the second lowest state in the entire nation for foreclosure starts, delinquencies on mortgages. We're in a very unique place, and as Heather said earlier too, inventory is continuing to drop, so we're in a good position.
Yeah, I agree. And with our unemployment rate is below our national average as well. So,
Right.
we are seeing a strong still employment, I think, environment right now. And why I kind of touched on new construction being so low. I mean, we're almost 2,300 homes. We have permits not being, built, homes not being built for next year. So that supply and demand is definitely, we're going to see that tighten in the next year to 2 years. So we're going to continue to track that throughout 2023, but just hopefully this has been some good insight for you guys. And again, if you want to reach out to either Dylan and Bryce, we can put your guys' information in this video too. But I hope that was helpful and answered some questions. Anything else you guys want to kind of point on? Brokerage, I mean, you did talk on the broker kind of model aspect. Anything else?
Yeah.
just, I mean, Yeah, just to reiterate, we love having these conversations. If it is something in your future plans, I mean, don't feel super pressure to like get an application, get docs and everything right there. Just to have a conversation, kind of get a game plan, even if it's 6 months out. We love having those conversations. I don't know. Bryce did mention that a lot of the retail lenders are struggling right now, and it is really there's a really big difference in pricing between broker and retail right now, and there pretty much always has been. But brokers like Fulcrum have been making a comeback in the market. Um, for one, our service, I think our average put to close is around 12 days
Hmm.
for 2022. On top of that, though, in 2021, HMDA, which is a government reporting agency, came out and actually tracked the average savings between a broker like Fulcrum and the average retail institution. And it was something like the average consumer saved over $9,400 throughout 2021. And that was a
Wow.
combination of closing cost reduction
Interest, yeah.
and then also the decrease in interest paid on your mortgage payments from having a lower rate. So it's lower closing costs plus lower rate got that savings, which is, I mean, $9,400 is not a small amount. So
No, yeah, for sure. Unfortunately, guys, there's not a lot of education about this sort of stuff. And Dylan and I know because we've worked at, we've seen the entire kind of mortgage industry from retail to banking to now brokerage. The only thing that you guys can control as the home buyer for your closing costs are the lender fees. Appraisal is going to be what it's going to be. Title is going to be what it's going to be. Whatever your homeowner's insurance, property tax, like those are all going to be what they're, going to be when you guys get on a contract. The lender fees is what you guys control. And so make sure you guys are working with, doing your due diligence to look at different places, hopefully, choosing a mortgage broker because there's a significant difference in, lender fees and also interest rate.
Yeah, I totally agree. And that's why they are my preferred lender because I think clients that come to me, and want to, I recommend shopping, a couple different lenders so that you can see what those payments are really going to look like. And I always say, come back to my lender and let's work numbers because 9 out of 10 of my clients will always go back to you guys because the payments are so different. And I think it does save them money, either closing costs, like you said. I mean, average 9,500. That's a good chunk in your pocket to save.
Yeah.
So it's definitely some great insight on the brokerage or broker kind of model, and hopefully that's gonna move forward and help you guys as a buyer or future buyer in the market to save a little bit of money and to shop rates. Come give these guys a chance. They're awesome to work with.
Cool.
yeah, appreciate it.
Thanks, guys.
All
Yep.
right, thank you.